Good morning, everyone. Thank you for joining us. It is Tuesday, February 4th, and we here at Harvested Financial are looking at the markets. So, today I want to talk about DraftKings. Big investors are on board, but will the stock double again in the next year? Ooh la la, what do we have in store here? Well, a lot going on today in the markets, but first I want to jump into some of our overall market snapshots. I'm looking at the SPY. It's up 382.92. That's a buck seven or 28 basis points. I'm looking at the VIX is down 44 cents, trading around 22.47. IWM is around 215.46, up a buck 25 or 56 basis points. And finally, we have the Qs that are up 85 cents or 32 basis points. So thank you so much for joining us. Happy Thursday, happy February 4th. But let's get right into some of the DraftKings talk. I've talked about how big investors are on board, but what are those headlines that we're seeing? Well, some of those big investors are the fact that ARK Next Generation has purchased 620,000 shares. So remember, this is Cathie Wood's ETF that is out there trying to find the next best thing. Of course, famous for her Tesla picks, and that has driven the stock up quite a bit. We're seeing stock up a buck 43 this morning already, or a little over 2.5%, after some pretty big runs. The second major headline that I'm talking about is the fact that the daily fantasy sports product has been expanded to Canada. So they have expanded their partnership with the NFL to bring the power of their daily fantasy sports to the Canadian market, and that opens up a pretty big opportunity for them too. Finally, in addition to all of this bullishness, we're seeing multiple analysts that are upgrading the stock. So I'm going to read quickly from some of these insights. We have Goldman Sachs, who is upgrading their stock from 45 to a target of 65 bucks a share. Additionally, we have Benchmark, who is also upgrading their stock. They were previously at 60. They've upgraded that to 66 bucks. So a lot of big players are coming in, and they're suggesting that this stock still has room to move. So how are we going to think about trading this? Well, of course, I'm going to go ahead and bring up my screen share. So I'm pulling up DraftKings, and we want to look at today some vertical strategies. It's Thursday. Let's look at how we can trade some call spreads and put spreads and what some of the differences are across the different terms. So I'm going to first pull up the Feb 19th expos. So we love trading the serial expos. They have the most liquidity. They have the most depth. When you're trying to get in and out of spreads and looking to maximize your profits, liquidity matters a ton, and the liquidity that serial month expirations provide is great. Market makers aren't too anxious to provide that short-term weekly liquidity because of the potential moves that can happen on that. But whenever everyone's pulling around the monthlies, there tends to be really good trading action and tight pricing. So let's look at Feb 19. You still believe you're bullish. You're liking this news. You're liking the fact that we have some big investors here. Not only are the analysts upgraded, but Cathie Wood seems to have the golden touch. So let's think about what we can do here. Well, I'm going to think about buying the 65.70 call spread. So I'm going to compare this $5 vertical. It's about $4 out of the money right now, $3.85 out of the money. And in the 15-day expiration, trading around 70 vol right now, we can buy this spread for about a buck, a little less than a buck if you get a nice price in there. Potential to make up to $5 on that trade for a total profit of $4. So 65.70 goes over 70 bucks, you will make $4 on your $1 call spread investment. Now, that has to happen in the next 15 days. So we're going to have to see the stock jump that $8 in the next 15 days, which is quite a big pop. So if you're really bullish, this presents a nice opportunity to spend a buck to potentially make $4 on that investment. So that's what that looks like in the very near term call spread. But how does that compare to something a little bit more long term? We're talking about a lot of these ideas that ARK is not necessarily a swing trader. They're not necessarily going for something that's going to pop immediately. They're looking for deep value, the next generation. And I think we're also looking at a longer term in terms of seeing how some of these daily fantasy sports are going to play out in the Canadian market. So let's stretch this a little bit farther, and I'm going to go all the way out to August. So August 20th is the August serial expiration. That is 196 days away. So it's the closest we have to like a 6-month trade out here. But comparing that sort of 2-week trade to a 6-month trade, let's see what the profit differences look like. I always find it interesting to look at these further out expirations and see where the different strikes are listed. If you'll notice, we have the 50, 55, 60, 65, 70 out in August. whereas we get much more granular strikes listed in the front month. We have 57.5, 58, 58.5, 59, 60, 61. So there's definitely room for more precision in some of the front months, but like we talked about in terms of the weekly options and how quickly those could decay and how quickly you're looking for that movement, having a little bit less flexibility but more time on your side makes it interesting to look further out in the terms. So going for that same 65-70 call spread, if I'm going to buy the 65 call, sell the 70 call, of course, the max gain or the max value of that spread is going to always be the strike widths. So it's that same $5 max value of the spread, but how much do we buy this for now? Well, if you want to buy the 65-70 196 days out, you will pay. Markets are a little bit wider here. I do have the midpoint around $1.90. Now, very important how much wider the markets are here. Not only is it further out, we need to price in a little bit more buffer, but also, these are higher dollar priced options. So, we're dealing with $11 and $10 options here, whereas when we were looking in the front month, we were looking at the difference between a $2 option and a $1 option. So, big difference. Not only are the penny decrements available for options sub $3, but the higher the handle, the higher the price of that option, I should say, the wider that market's necessarily going to be, because pricing in a little bit of that liquidity uncertainty. So going all the way back to that August spread, so remember, we paid $1 in Feb to get that 65-70 exposure, and if we go out to August, like I said, there are wide markets. Whoops, wrong strike there. So by the 65 to sell the 70, wider markets, but that midpoint is around 190, like I said. So a little bit less than double the price. Now, assuming you can get executed around that 190, I'd wager you could probably get in around $2. So think about that as almost about double what you would have paid in February. You're paying double that to get 180 additional days. So you have 196 days versus 15 days. So you have that much more time. You have almost 6 more months for that rally to materialize, and for GameStop for DraftKings to trade over $70. So you pay $2, your max profit is going to be $3 on that trade. Invest 2 to make 3, max value of 5. But you have a lot longer of a time horizon to make that work. So really interesting to compare the differences between a far out month call spread and a relatively near month call spread. If you want to think about paying that same dollar in August, where can we get executed? Well, we'd have to go up to the 75-80 call spread. Actually, we can do it at the 70-75, it looks like. Nope, that's still a little expensive. So if you want to pay that same dollar, no, that's not even a dollar. So, that same dollar, you'd have to go up to almost the 80-85. And, these markets are wide, so it's a little bit hard to know where exactly you'd get executed. But paying only $1 in August, to make that same $5 of a max gain or a max spread value, you're going to have to go up to the 80-85. So it's really interesting to compare how much you're getting into, how much you think you could potentially make on a trade, and how long you have to let that happen. So a lot of really interesting dimensions to the time aspect here. And if you're bullish on DraftKings, looking out further term for potentially a little bit more capital gives you a lot longer time horizon to let that materialize and let the stock trade over $70. So Harvested Financial excels at doing strategies like this, systematically implementing exposure for individuals in individual portfolios to deliver the power of derivatives. You can check us out here every single day, Daily Bread. We're talking about option strategies. We're talking about how to trade the markets. And we're talking about what it means for retail investors to have exposure to options. Thanks for joining us. Make sure you hit the subscribe button. Make sure you sign up on our website to get the Daily Bread in your inbox every single day. And as always, check out our Twitter at harvested_DAFE, where we're putting out all kinds of interesting content and helping investors understand the options markets.